You bought the silver because, at some level, you no longer trusted the promises. Not the promises made by politicians during election years, not the promises made by central bankers every time inflation surged beyond expectations, and certainly not the promise that an economic system drowning in debt could somehow continue expanding forever without consequences. Every ounce you purchased felt like a small declaration of independence from a world increasingly built on paper, coins, and financial engineering, while others were chasing stocks at record valuations or speculating on the latest digital asset. You were accumulating something that had survived thousands of years of monetary history, and for a long time, it felt like nobody understood why. Then everything changed. Silver began climbing. Gold pushed into territory that only a few years earlier would have sounded absurd. Investors who had spent years patiently stacking metal suddenly found themselves sitting on gains large enough to command attention. The market was finally validating what they had believed all along, but hidden behind the excitement of rising prices was a question almost nobody wanted to discuss. Not where silver would go next, not whether gold could reach another record high, but what happens when you eventually decide to sell. Welcome back to Ray Dalio's Talks. Today we need to discuss one of the most misunderstood realities in the precious metals world, a reality that becomes more important with every dollar silver rises and every new high gold achieves, because there is a difference between owning an appreciating asset and successfully converting that appreciation into lasting wealth. Most investors spend years learning how to buy precious metals. Very few spend any meaningful time learning how to sell them properly, and that gap in knowledge is creating risks that many people will not discover until it is already too late. The financial world has a strange habit of making simple things complicated, and complicated things appear simple. Buying silver feels simple. You exchange currency for metal and place that metal into storage. The transaction seems straightforward, but the moment that metal begins producing significant gains, an entirely different set of rules enters the picture. Rules involving documentation, reporting requirements, holding periods, and taxation. These rules do not care why you bought silver. They do not care that you were concerned about inflation. They do not care that you viewed precious metals as insurance against financial instability. They care only about one thing: the numbers. This is where many investors encounter a reality they were never prepared for. The government does not evaluate conviction. It evaluates transactions. It does not measure how strongly you believed in silver when nobody else did. It measures what you paid, what you received when you sold, and the difference between those two figures. Everything else is invisible. The years spent researching monetary history, the countless hours listening to economic forecasts, the patience required to hold through volatility. None of those things appear on a tax form. What appears is the gain. And in 2026, those gains have become substantial. Investors who accumulated silver several years ago are looking at profits that once seemed impossible. What began as a modest position has evolved into something far more significant. The problem is that large gains often create a dangerous sense of confidence. People become so focused on what they made that they stop thinking about what they might lose. Not to a market crash, not to a collapse in silver prices, but to poor planning. History repeatedly demonstrates that wealth is not lost only through bad investments. Sometimes it is lost through administrative mistakes. Sometimes it is lost because records were never organized. Sometimes it is lost because assumptions replaced facts. And sometimes it is lost because investors believe that understanding the asset automatically meant understanding the rules surrounding the asset. Those are very different things. The most successful investors are rarely the ones who simply make the largest gains. More often, they are the ones who preserve the highest percentage of those gains. They understand that investing does not end when an asset appreciates. It ends when the entire process has been completed successfully. Buying matters, holding matters, but planning matters too. Without planning, even an excellent investment can produce disappointing results. What makes this moment especially important is the broader economic backdrop surrounding precious metals. Global debt continues reaching levels that would have seemed unimaginable a generation ago. Governments continue borrowing at extraordinary rates. Interest payments consume increasing portions of public budgets. Central banks continue navigating an environment defined by inflation concerns, slowing growth, and financial instability. These conditions have helped support precious metals prices and strengthened the case for owning hard assets. Yet they have also increased the importance of understanding every aspect of ownership, including the responsibilities that arise when gains are eventually realized. Many investors assume that because precious metals represent financial protection, the administrative side of ownership somehow takes care of itself. It does not. The market rewards patience. The tax system rewards preparation. Those two rewards are entirely separate. An investor can demonstrate tremendous patience while showing almost no preparation. Unfortunately, the consequences of that imbalance usually appear at exactly the wrong time. Imagine spending years building a position, resisting the temptation to sell during downturns, remaining disciplined while others lost confidence, only to discover that incomplete records or poor planning significantly reduce the wealth you worked so hard to create. That outcome is more common than many people realize, not because investors are unintelligent, not because they lack discipline, but because they focus overwhelmingly on the exciting parts of investing and neglect the less exciting responsibilities that accompany success. The reality is simple. The larger your gains become, the more important preparation becomes. Small mistakes that seem insignificant during the accumulation phase can become extremely expensive during the liquidation phase. Documentation that feels unnecessary today may become invaluable tomorrow. Decisions postponed for years can suddenly demand immediate attention, and investors who never developed a clear strategy often find themselves making critical choices under pressure. That is why education matters. Not sensationalism, not fear, not conspiracy theories. Education, understanding how systems operate is one of the most valuable advantages any investor can possess. Markets change, governments change, economic conditions change, but informed decision-making remains valuable in every environment. Investors who understand the rules can adapt. Investors who rely on assumptions eventually encounter reality. The years ahead are likely to remain volatile. Economic uncertainty has not disappeared. Inflation concerns have not disappeared. Questions surrounding debt, currency stability, and global growth have not disappeared. Precious metals may continue benefiting from those conditions. They may continue attracting investors seeking security in an increasingly uncertain world. But regardless of what silver or gold prices do next, one principle remains constant. Wealth is not measured by the size of a gain. Wealth is measured by how much of that gain ultimately remains under your control. And that is the lesson many investors are only beginning to learn. The market can create opportunity. The market can create profits. The market can create life-changing gains. But turning those gains into lasting wealth requires something more than conviction. It requires preparation, awareness, and a willingness to understand the rules before they matter rather than after they do. Because by the time most people realize the importance of planning, the opportunity to plan has already passed.